Everybody can everybody can see the screen right now.
Yes, clear
Perfect,
and correct.
perfect.
Yes.
As I mentioned today, the topics will be S&P 500 performance after the Trump administration, because all of you know that what's happening in today's world, we have lots of measures, especially in trade side about the Trump tariffs, which is specialized on and focusing on generally Mexico, Canada, and China. But we know that it's expanding to Europe or any other type of parts. 2 days ago, Trump declared that if the Putin does not accept any type of treaty between the Russia and Ukraine, they will put some additional tariffs on Russian oil as well. So let's start the presentation with the charts and their details. Please take a look at this chart first. This is S&P 500, and here, as you see in the x-axis, you will see the time frame for the details. It is trying to cover the general here, as you see, from 1990s until today, approximately 30 years we are trying to cover. And here on the left-hand side, you will see the index number for the S&P 500. How is the performance of S&P 500? This black line is showing the S&P 500, and the green line showing the price earning performance. And I want to take your consideration into this table. This is the characteristics, the index level, price earning ratio, PE performance, dividend yield, and the 10-year treasury yield, the alternative investment for the S&P 500. And here you see some dates, 5 dates, 2000, 2007, 2020, 22, and 2025. Why these dates are important? Because as you see, in 2000, 2007, please take a look at the charts. 2000, 2007, here 2020, here 2022, and 2025. These are the inflation points. Why inflection points? Why it is important? Because these are the S&P 500 index reached the highest numbers, peak up the highest levels in the history until that day. Then it started to decline. In the 2000, we have a dot-com internet crisis in the United States. In 2007, we have the global financial crisis all around the world. In 2020, we have the COVID-19 crisis, and here we have the Russian-Ukraine conflict, the geopolitical crisis in the world. The index level from 2000 till now, in 25 years, approximately quadrupled, meaning that if you put $1 million in the index, it is now $4 million in 25 years. Logical game. And the price earning performance, why this price earning performance is important? Because price earning is an indicator, ladies and gentlemen. It is an indicator for any type of investment. It can be a stock, it can be an equity, it can be a corporate, it can be any type of things. The price earning ratio and its performance showing how that investment is cheap or expensive, how much it is expensive or cheap. So if I have a price earning ratio like this, 25 or 15 or 19 or here, as you see, please take a look at the price earning performance in the indexes. And it is saying to us that normally the price earning performance until the COVID-19 crisis is around just 16. The average for S&P 500 is approximately 16. Why this average is important? If we are in the above the average curve, in the price earning performance, this means that basically, yes, we have other details. We should check other points. We should check the balance sheet. We should check the income statement. We should check the cash flow. Yes, those are the details in the kitchen. But just by taking a look at the picture, may I decide whether this is cheap or expensive? The basic answer is yes. If the price earning ratio is above the average, this investment is expensive for you. Okay, meaning that price in the stock exchange or price in the any type of valuation is higher than your earnings. Price is high, okay, and it is expensive. So the basic logic by just taking a look at the price earning ratio and performance and to decide whether it is expensive or cheap, the decision making process is like take a look at the average curve of the price earning ratio. If current price earning ratio is above the average, it is expensive, or vice versa. If it is below, it is cheaper. So here today, at the end of January, it is approximately 22. And what we know that the average is 16. What is the answer? And so you can ask this question yourself and then answer by knowing how you make the decision making just to take a look at the price earning ratio. The decision making process is this. Today, the price earning is 22 in the United States, but I know that the average is 16. So if anybody of you want to make an investment in the United States Stock Exchange, S&P 500, it is expensive. Okay, because current price earning ratio is higher than its average. This is the basic answer for this. And for instance, in the global financial crisis, it is less than the average. So you can take any value, any position here. For instance, if you take a look at here, it will be around just 13. And the price earning ratio average is 16. So you are below the average. So this investment is cheaper for you. You can take a position. So another answer, what should I do while taking a position in the United States Stock Exchange? If the price earning ratio above the average, sell off everything. If it is below the average, buy any type of position in the index. Another matrix for the dividend yield, another valuation. Dividend yield is what? Dividend yield is this. Let's say Dr. Walchin take a position in Tesla or Amazon. He buy $1 million stock. Okay. And let's say Tesla has approximately 3 trillion stock in the stock exchange. And Dr. Walchin take a position for 1 million. At the end of the year, Tesla making a press release for their income statements, right? They have quarterly financial declaration, how the performance of the company. And each quarter in March, June, September, and December, you will see the net profit or net loss of the companies. Let's say the Tesla declares approximately $600 billion net profit at the end of the year, $600 billion profit. And the higher management committee making a decision that they will distribute 10% of net profit to the shareholders, meaning that $60 billion will be go to the shareholder account. And Dr. Walchin, because of their $1 million investment, get approximately $10,000 or $20,000 as dividend. So you should understand that dividend yield is this. You are making an investment, you are a shareholder in that company, and from the profit as a shareholder, you get a portion. This is your dividend yield. because of your investment. And what is 10-year treasury? 10-year treasury, we have in treasuries or governments, we have risk-free investment asset like the treasury bills and government bonds. Okay. This can be short-term, like 3 months or 1 year, or this can be long-term, 2-year, 5-year, 10-year, or 30. 10-year treasury yield is a macro indicator in the United States to look at the risk-free asset, how it is performing. Okay, this is a benchmark for you to compare your investment with a risk-free asset. Why? Because you are in a risky asset. Risky asset means you are in S&P 500. You can lose your money with a huge risk, right? At the end of the year, you can lose half of your money because stock exchange means you are taking a position in a risky asset. You are in risk. But in 10-year treasury yield, your risk is covered by the treasury. Okay, it is a risk-free asset. So while comparing your performance in the stock exchange, you should also take a look at how is the performance of the 10-year treasury yield in the United States. Now, let's take a look at the S&P valuation. What I said to you a few minutes ago about the valuation metrics for the S&P 500 PE ratio. Please take a look at this. Here, we have from 1995 until here, approximately 30 years. And here, I have the price earning matrix valuation. What we know about the price earning? Price earning is a metric, valuation metric, to show whether the company is cheap or expensive. And here you see on the black line, this one, is showing the price earning path throughout the history during the 30 years, from 1990s until today. And here you will see the 30 years average, this dashed dot, green line. What is the sentence saying? The 30-year average is around 17 for the S&P 500 price earning ratio. Okay, S&P 500 price earning ratio 30 years average is 17. And here, if this is deviate 1% from the average, it will be around 20. And it will be deviate minus 1% from the average, it will be around 13.6. Why this minus plus 1% standard deviation is important? Because sometimes while we are calculating the moving average or any type of statistical indicators, one plus or minus standard deviation can be negligible. You can up or down between these boundary lines. But if the numbers above this boundary like this or below this boundary like this, you are in another path. So let's look at here. You are in 2010 and price earning is approximately 11. And you know that average of the price earning ratio in the S&P 500 index approximately 70. What should you do? You should sell everything in your asset and buy the stocks in S&P 500 because it is really cheap. The basic logic in investment is this, ladies and gentlemen. Sell the expensive and buy the cheap. Okay. Otherwise, you will just save your money against the inflation. You will not be rich. Okay. If you want to be a rich person in the world, in your stock exchange, or in any type of investment you make, you should sell the expensive and buy the cheap. And if you are here, please buy everything in the S&P 500 because it is really cheaper. But if you are here, sell off everything because it is really expensive and it will go down. You will lose huge money because of your investment. And I have another valuation measures. This table is really, really important. Why it is important? Because you know that we have lots of investment banking all around the world, Goldman Sachs, JP Morgan, Morgan Stanley, UBS, HSBC, or Citi. These banks and these analysts using different type of metrics to value their investment and to decide whether it is cheap or expensive. And the basic one is this one, price earning ratio. But I have another metrics. This is price earning ratio in the chart, but I have this CAPEX. I'm sure some of you have an idea what is CAPEX. Generally, we are calling it as CAPEX as well. What is CAPEX? CAPEX is capital expenditure in your investment. I mean that if you are making an investment in your company, and if you buy, let's say, a machinery equipment in your company, it is a capital expenditure for you. Okay. And the description for you that similar price earning ratio. Okay. And here you will see other metrics for the capital expenditure. And dividend yield, a few minutes ago, I mentioned the dividend yield, and it is details what we mean by dividend. But CAPEX and dividend yield can be negligible compared to these two. Why these two is important? These two are important as much as the price earning. One of them is P over B, meaning that price to book ratio. And second one is P over C5, meaning that price to cash flow. What we mean by price to book ratio? Price to book ratio is this one. Let's say Dr. Walchin have a company in the Texas, in a big field. They are producing the washing machine. Okay. And it has approximately 500 employees there. And let's say Dr. Walchin company is also quoted in the S&P 500. It is also an index and a company in stock exchange. Dr. Walchin, as a company owner, with the field, investment, machine, employees, factories, he knows that what is the real value of the company, right? The book value, meaning that if I sell this company with all the field, all the machine inside, all the electricity equipment, all the automation, all the employee income, all the fixed asset, what is the book value of this company? Let's say it is $200 million. And let's say Dr. Walchin company in stock exchange has a market value approximately $250 million, meaning that price to book ratio is 250 over 200, meaning that approximately 5 over 4 or 1.2. Price to book ratio is a good indicator that how much your company cheap or expensive. If the price to book ratio is less than 1, let's say, what this means? Your company has a real value. It has a factory. It has an equipment. It has a machinery on the field. And its value in the stock exchange is less than the field value, less than the real value. It is cheaper. So go to stock exchange and buy the stocks of that company because it is really cheaper. So price to book ratio, price to cash flow are the one of the best indicators in the world for valuation metrics to decide whether this company is cheap or expensive, as much as like the price earning ratio. Now, another chart for our valuation, price earning ratio and equity return. Please take a look at the chart. On the left-hand side, we have forward price earning ratio and 1-year return. And on the right-hand side, we have price earning ratio and 5-year annualized return. So How we can calculate and decide whether these are related or not? Please take a look at the left-hand side chart. Here on the y-axis, I am seeing the 500 return. Okay, this is the return index. And here, this is the 1-year return in the cash value. And what is regression line telling us? What is showing us? It is saying that Telmarine Jackson, your microphone is open. Could you kindly close it? Telmarine Jackson, your microphone is open. Thanks a lot. Thanks a lot for your attention. As you see, ladies and gentlemen, this orange line, look at this Telmarine, your microphone is open. Could you mute it?
Ladies and gentlemen, please, I am requesting your cooperation. I just turned all microphones off because one participant was having a significant noise in the background. So at this time, we only gonna be able to hear Dr. Abdulkadir D in his presentation. Thank you, Dr. Dogan. You may continue, please.
Thanks a lot, Dr. Walshin. Here you see an orange line between the y and x axis, and it has a negative slope, right? It has a negative relationship, meaning that total return and price earning ratio has a negative relationship. What does this mean? If the price earning ratio is higher, you will lose the money. The basic answer and basic relationship between these two. By the way, this R square showing just 7% significance and fitness of good value. This R square is a statistical computation showing how much your regression analysis explain the relationship between dependent and independent variables. So this 7% is low, but in any other cases, if it is like here, as you see 20% relationship and explanatory value, or how can I say, power of the significance, here as you see, in any case, on the left or right-hand side, the orange line saying us that the relationship between the price earning ratio and the S&P 500 is negative, meaning that if your price earning ratio is going above, total return index will go down. So you will lose the money. Okay, it is expensive. You will lose the money. And here on the right-hand side, we have a little bit steeper, not flatter, but steeper orange line, meaning that in short term, the negative relationship is higher. But in long term, even if you lose the money because the price earning ratio is higher, in the long run, in the 5 years, it will be less sensitive. Okay, because you will cover your loss. You will compensate it in the long run. Now, let's take a look at the S&P 500 year-over-year performance of EPS growth. What we mean by EPS? EPS is earning per share. Okay, if you have a share, what is the earning per share for that company? Okay, and this is a good indicator for the profit margin of the company. On the sources of earning growth, please take a look at here. Again, from 2000 until now, 25 years we have. And here, as you see, we have a table in 2024 and average between 2000 and 2023. The 23 years average is here and 24. is here. What is the margin? It is 8.1, but the average is just 2 or 3, meaning that the margin is EPS growth is really, really high in 2024. You are earning huge money, and this is a signal for you. Something is going wrong because nobody earn money until forever, ladies and gentlemen. Okay, if you earn every day, something going wrong because some storm is coming, some turmoil is coming in the stock exchange, it means. Okay, you should sell off something at any logical point. For instance, the revenue, despite the margin is 8.4, the 20 years average for the year revenue is 4.2%, but the revenue is just 1.6% in 2024. What does it mean, boy? Revenue is lower, but margin is really high, right? You have a really good margin in your stock exchange. And share count, it is minus. And the total EPS, normal, the average is here, 7.2, but earning per share is 8.7 in 2024, higher than the average, right? So, as I say, if your investment going above the average in any type of investment, it can be stock exchange, can be any type of investment, you should be really, really careful about your investment that something going wrong if you are really deviating from the average line, average path above the one standard plus deviation. And here, please take a look at the right-hand side chart. This is S&P 500 profit margin, quarterly profit margin. This green dashed line, please look at here and here. This one is thin, and this one is a little bit fat. These two dates are two crises, recessions. One is global financial crisis in 2008, and this slow and thin one is the COVID-19 crisis. And in this crisis, profit margin is crashing. Do you see? Normally you are here at 10% profit margin, and it is dropping in just one quarter, 5%. Or before the COVID-19 crisis, you have a 13% profit margin, and it is suddenly in just one quarter dropping to 9%. But today, in any other turmoil, in any other deviation from the long run path, here from here to here, you are starting from the 5, from 2000 global financial crisis until here with some deviation. Yes, we have fluctuation going up and down, but in any other case, the profit margin for S&P 500 is really good, 13%, meaning that if you take a position in S&P 500 stock exchange during this 25 years, you have a profit margin around 13%, and it is really, really good. Value and the growth. Here, as you see, cash. This is cash at your balance. This is research and development activities, and this is your capex. What we mean by capex? Capital expenditure, as I say. Please take a look at here. We have lots of different sectors: utilities, materials, industrials, energy, consumer staples, financials, overall S&P 500, healthcare, consumer discretionary, technologies, communication services, and real estate. And if I take a look at how much the corporate cash as a percentage of corporate asset, meaning that how you are risky. You have how much cash in your balance, and in any type of risk, what can you do with your cash? The lower cash compared to the fixed asset, okay, current asset, it is the lowest for the utilities with 14%, and it is highest for the real estate with 51%. What we mean by here, 51%, meaning that you have a current asset in your overall company, and 51% of it is cash in real estate sector, huge money. Meaning there is no possibility for real estate sector go to any type of crisis because they can fight and deal with any type of crisis, even just with the cash. No need to go to the credit or loans. You have huge cash in your balance. By the way, what we mean by growth and value, these two definitions and the topic is important. Value is a company which proved its success and its performance throughout the history, like the Microsoft, like the Apple. These are the value sector. These are growing slowly, but they have a real value in the world. But the growth is we have some new companies like, how can I say, enterprise, small companies, and they are growing really, really faster. Even your profit going 50% in 1 year because these are just an enterprise firm and their profit margin, their revenue is growing every year with a huge percentage, with huge performance. And the value, meaning that you have a value, you are growing less, but you have a brand name in the world. And on the right-hand side, please take a look at here, how these value and growth companies making investment in their research and development activities and in their capital expenditure. As you see, growth companies making huge capital expenditure investment and value companies making huge research and development. Why? Because if you have a value company in the world, you don't need to make huge capital expenditure because you prove yourself. You need to increase your capacity and increase your value addition with lower time, with higher revenue. And it is coming from the research and development activity. And now, another performance indicator for the S&P 500, this is index concentration and valuation. Please take a look at here. On the left-hand side, we have price earning ratio of the top 10 companies and remaining stock in the S&P 500. Top 10 is green line. Okay, this is the price earning of the green line. The remaining stock in the S&P 500 is the blue one. And the overall S&P 500 is the black line. What you see here, in 2000 dot-com crisis, the top 10 is approximately 44 or 40 price earning ratio, but S&P 500 is just around the 20, meaning that top 10 companies who is growing huge, 2 times expensive as much as the average S&P 500 because price earning ratio for overall S&P 500 is just 20, but top 10 is around 40. And in global financial crisis, all are converged to each other. They are around 10. And with the COVID-19 crisis, please take a look at here, huge pickup. The top 10 is around again 40, but the S&P 500 just 20, 24. And the remaining stocks is around 19. So some companies from this picture, you can basically understand that some companies in the stock exchange have positively diverged from the average and they can have a good performance compared to the overall average. And on the right hand side, please take a look at here now on the chart. Weight of the top 10 stock, meaning that what is the market value of these top 10 stock in the stock exchange? And they are here normally 20% in 2016, but now it is approximately 40% because just the NVIDIA approximately $4 trillion market value in the United States Stock Exchange. Ladies and gentlemen, $4 trillion means that NVIDIA is bigger than the Italy, or NVIDIA is bigger than the Spain. one company has a higher value than a big economy in the European Union, like Spain, like Norway, like Switzerland, like Italy. Just NVIDIA. Please take a look at this consideration. Just NVIDIA has a higher value than Italy or Spain. This is huge. And their weight is pick up to 40% in the S&P 500 with the market capitalization. And economic concentration in the S&P 500, as you see here, what we mean by concentration of the S&P 500 in these metrics, these are showing us that here, as you see, research and development expense, free cash flow, operating income, capital expenditure, sales, and employees. Employees getting the lowest portion, and the research and development expenses getting the higher portion from the overall economy. Why? Because these employees' wage are just changing with some tenure or with some the inflation adjustment, but R&D expenses all around the world, especially in China, especially in the United States, the highest concentration of the companies to create the value addition in the company. One of the another important picture for us. Please take a look at the title, Magnificent Seven Performance. Ladies and gentlemen, we have 7 giant companies in the S&P 500. These are called as Magnificent Seven. And these companies are here, as you see. Apple, Amazon, Google, Meta, we have Microsoft, NVIDIA, and Tesla. These companies' total market value is higher than the England, higher than the Germany, higher than the Japan. Their market value is higher than the gross domestic product of these countries. These are magnificent. And their performance, as you see here, is really positively diverged from the S&P 500. Please take a look at the S&P 500 performance. If you put $1 million here, it will be in S&P 500 $1.6 million in the S&P 500 just in 4 years. But your $1 million in your Magnificent Seven investment will be $2.2 million. Meaning that just with $1 million investment, you are earning $600,000 higher than the S&P average if you put your money in the Magnificent Seven index. This is a really positive divergence from the index. And today, we are seeing, especially in last 2 months, we are seeing the Magnificent Seven market correction. Their stock value is going down, even in Tesla, even in NVIDIA, even in Amazon, even in Microsoft, because their investors get huge money from their profit. Okay, they are at their take profit line and selling off. I want to skip this return and valuation metrics because I want to mention this detailed chart in the next couple of weeks in another detailed presentation. But I want to focus on this annual return and intra-year decline in the S&P 500. And if we have some market valuation, how the stock exchange can react to these lines. What we mean by this? We mean by this S&P 500 intra-year decline. Please look at these red dash lines. These red dash lines showing us that from the highest point in the stock exchange, how we earn and lose the money in the stock exchange if we take a position in that company. And from that point, how much we compensate our losses. Here we are, as you see. What does it mean? We have a huge correction. Even just take a look at here. If you lose 10%, next year you will earn approximately 23. Let's look at here. If you lose here 12%, I will earn 19% next year. So patience is everything in the stock exchange, but your patience should be around on the correct station. If you're waiting the bus in the wrong station, you will wait until forever, ladies and gentlemen. Okay. While taking a position, please take a look at the real metrics and how these companies' valuation can be fluctuating throughout the historical performance and their price earning ratio or any type of other valuation metrics. And here, last two slides. One of them is small capital expenditure, mid capital expenditure. These are small capital firms or mid capital firms or large capital firms. And the sector composition here: information technology, financial, consumer discretionary, healthcare, communication services, industrials, consumer staples, energy, utilities, real estate, and materials. As you see here, please do take a look at large capital companies are concentrated in information technology, like Amazon, like Microsoft, like Apple, like the Google. And the low capital firms, small capital firms, are in general focused on the material or real estate. Financial, the banks are large capital firms, right? These are the large companies. And these are the earnings. Please look at this one. Earning per share growth of the large capital, mid capital, and small capital companies. Small capital companies, as in the name, they have just small companies. They have just an enterprise. And their earning and profit is really growing faster. So, as you see, in just 1 year, their profit earning per share is 58% because they have just small companies. This is base effect. I mean, how you call in your language, I don't know. But let's say from 100 to 150, how much you increase? 50, right? But what is your increase in percent? 50%. From 150 to 200, how much you increase? Again 50. But how much you increase with percentage? 32, right? 33. As you grow, as your value is growing, the same amount has lower effect in your percentage growth. This is base effect. So small companies have higher base effect in their growing, earning per share growing, but the large firms has just small growing in their earning per share. And again, the last slide from our presentation today, as I said, the important thing is this: while you are making investment in S&P 500, you should check how much risk your company, how much debt, how much loan, how much credit they have, how much revenue, profit, EBITDA, or any type of operating income in their growing cycle, and if any type of crisis, how much cash, corporate cash, they have in their account to cover and deal with any type of risk in the market.